Hello, this is the Chapter 6 synopsis, and in Chapter 6, we're going to talk about the determinants of interest rates. So we're going to talk about the cost of money and interest rate levels and what factors make up interest rates. And then these last two sections, well, the term structure of interest rates we're not covering, and using yield curves to estimate future interest rates we're not going to cover. So be sure that you look at the reading assignment that shows the pages that we're going to be covering. We will talk about yield curves though. So let's forge ahead and talk about the four factors that affect interest rate levels. So the four factors are production opportunities. Basically, that means when we're talking about interest rates and we're not really talking about interest rates in terms of us as investors. We're talking about interest rates as they affect, predominantly as they affect companies. So if interest rates are high, companies are going to be less likely to expand because the cost of capital is higher when interest rates are high. When interest rates are low, they're going to be more apt to expand. So companies like interest rates that are low because it makes the cost of capital cheaper. So production opportunities are going to affect the level of interest rate. If there's a lot of production opportunities out there, in other words, a lot of projects that companies might want to undertake, that's going to increase the demand for money. So that will make interest rates rise. Time preferences for consumption. What that deals with is, as consumers, when we put money in a savings account, when we save money, that's money that's available to be loaned out in the capital markets. So if we have a current time preference for consumption, we're not going to be saving much money. So think about the supply and demand for money. If we have a current time preference for consumption, meaning we want to spend all of our money today on consumer items, then the supply of money will be less, and that will cause interest rates to go up, and vice versa. Risk, the riskier a project is, the higher interest rate there's going to be. And then inflation expectation. If inflation will make interest rates go up. So the higher inflation, the higher interest rates are going to be. Now, there's several components. I'm going to come back to this slide. There's several components that make up interest rates. So this is the formula. So R is the nominal interest rate, and the nominal interest rate is the stated rate. So if a company issues bonds and they're paying 8% on their bonds, that's the stated interest rate or the nominal rate. And so these are the determinants that make up the interest rate. Okay, so the first two determinants that we're going to talk about are on the prior slide. The first determinant is the risk-free rate of return, the real risk-free rate. So R, just the plain R, represents the nominal rate. R star represents the real risk-free rate of interest. So for example, if you went if you went to the bank and you bought a T-bill, you bought some T-bills, or you put your money in a CD, and you're making the interest rate that you're making on a CD or on a treasury bill is called the risk-free rate, because the government's not going to default on their bonds. A T-bill is a government issued bond. So when they say in the textbook, when they refer to the risk-free rate of interest, that's the rate on a government bond, like a T-bill. The real risk-free rate is when you subtracted out inflation. So when inflation typically is about 2% these days. So think about this. If you went and bought some T-bills and you were making 2% on those T-bills, which you would be lucky to get in this day and age. If you're making 2% on these T-bills, there's 2% inflation. What's your real risk-free rate of return? What's your real risk-free rate of interest? 0, 2 minus 2. So the nominal rate is R. R star is the real risk-free rate. And then what we refer to as the rate of interest on treasury securities, if you buy government bonds, is the risk-free rate. So that's the nominal RF, just means risk-free. Okay, let's go back to this formula. So the nominal interest rate on bonds equals equals R star, the real risk-free rate of interest, plus the inflation premium, plus inflation, plus a default risk premium, plus a liquidity premium, and plus a maturity risk premium. Okay, so let me explain. Well, let me just explain what these are, and it'd be easier to do it on this slide. So a government bond, that's a short-term government bond, meaning it's going to mature in 1 year or less, simply has the risk-free, the real rate of return plus the inflation premium. If you have a government bond that is going to mature in a time period that's greater than 1 year, you have to add what's called the maturity risk premium. And that simply means that you're going to get a little bit more interest because the further out you go, the more risk there is. So just to repeat this, a short-term government bond is going to have two components, these two things. A long-term government bond, well, greater than a year, so a mid-range or anything that with a maturity of greater than a year, mid-term to long-term is going to have these three components, these two plus the maturity risk premium. A corporate bond is going to have those three items plus these two. A liquidity premium, because it's really easy to cash in a government bond. It might be a little harder to sell a corporate bond. So they give you a little bit more interest for what's called the liquidity premium. And then corporate bonds also have a default risk premium. You'll notice in the book, towards the end of the chapter, they have S&P and Moody's are two bond rating companies, and they'll grade these bonds ranging from AAA down to B's and C's and so forth. And so make sure you read that portion of the chapter that tells what the different grades of bonds mean. Anything that's graded a B, a single B or below, typically is called a junk bond or a high yield bond. It simply means the company is a higher risk company. So the bonds have a lower grade, meaning they're going to have to pay a higher interest rate. So a corporate bond could a corporation could default on their bonds, whereas you don't expect the federal government or to default on the bonds. So a corporate bond is going to have a default risk premium. The better grade the bond, the lower the default risk premium. So these are all the components that come together to make up the nominal interest rate. Okay, and this is just repeating what I said. They're telling you what is in the formula for the different types of bonds. Here's a short-term treasury bond, just has the inflation premium. Long-term treasury bond's you add the maturity risk premium. Of course, they all have the real rate of return up here. A short-term corporate bond, there's really no such thing as you never see short-term corporate bonds, so just skip that, but it wouldn't have a maturity risk premium. Long-term corporate bond has all four. This is a yield curve. So what they do, what people will do, analysts, economists, so forth, they will calculate the interest rate over different times to maturity. And so they use that formula. And here's an example of some interest rates on treasuries. Short-term treasuries, less than 1 year maturity, intermediate term, 2 to 10 years, and then long-term 10 years and beyond. And so the reason why you have this upward sloping yield curve is because we typically expect the inflation premium, we expect inflation to rise over time. So the further you go out, the higher the inflation is typically. And also the further out you go, the higher the maturity risk premium is. So there's more uncertainty the further you got in time. So typically you will see an upward sloping yield curve. So you see here, this is from 2018, a 20-year treasury was paying around 3%. Whereas if you bought a 1-year treasury, you could get about what, 2.25%. So this is called a normal yield curve because it's upward sloping. Now, occasionally you can see what's called an inverted yield curve, where it goes like this. Starts way up here, and then in the longer term, it's going to be lower. So that only happens during times of high inflation. Back in the late 1970s, early 1980s, we had inflation actually at 18%, 16, 18%. And so we saw this inverted yield curve because you had really high rates, but of course you wouldn't expect inflation to stay at those levels, which it didn't for forever. And so inflation was expected to come down. And so you saw, if you look at a yield curve back in the 1980s, you would see this inverted yield curve. Starts here and goes like that. So you see that during times of high inflation. Rarely you have what's called a humped yield curve, where the intermediate term rates are higher than the lower, than near term or long term, but that's rare. Okay, so this is the normal yield curve. That's what you typically see, an upward sloping normal yield curve. And it is just illustrating the rate of return, the rate of interest on a bond to its term to maturity. So this is a government bond. If you looked at a yield curve for a corporate bond, it would be higher. It would be up here because you would have to add this liquidity premium and the default risk premium. The more risky the corporate bond is, the higher the yield curve is going to be as a result of the default risk premium. Okay, so now we're going to do some of these calculations. They're pretty simple. This is just explaining how we calculate the inflation premium. All they're saying here is that you add up it's the average inflation. So you're going to add up all the inflation rates that are given, divide by N, and that gives you the inflation premium. Here's an example. Assume that inflation is expected to be 5% next year, 6% the following year, and 8% thereafter. What would the inflation premium be on a 1-year bond? Well, it's going to be 5% because it's 5% divided by 1 is 5%. What would the inflation premium be on a 10-year bond? Well, you just take the average of the 10 years, 5% next year, plus 6% the following year, plus 8 years at 8%. So we'd have 5% plus 6% plus 8%, 8 times. They're just doing a shortcut here, and they're multiplying the 8% times the 8 years. So you've got 1 year at 5, 1 year at 6, 8 years at 8%, divide the whole thing by 10 years. And on a 10-year bond, the inflation premium is going to be 7.5%. This is calculating the inflation premium for a 20-year bond, 7.75%. So we're going to need these to calculate the nominal rate of return for a 1-year bond, a 20-year bond, and a 10-year bond and a 20-year bond, which we'll do in a few slides. So that's how you calculate the inflation premium. The maturity risk premium is usually a really low number. It's 0.1% typically. So they're saying here that the inflation premium is 0.1% times T minus 1, T meaning the number of years to maturity. So in other words, if you had a 10-year bond, well, let's see on the next page. If you had a 10-year bond, you're going to multiply it 0.1 times 9, 10 minus 1 years. If you had a 20-year bond, you multiply the 0.1% times 19. It's going to be 19 years. It's going to be 1.9. If you had a 1-year bond, remember with a 1-year bond, there's no inflation premium. That's why we have the T minus 1 in the formula here, because on a 1-year bond, you'd have a 0 inflation premium. Okay, so now they're asking to add up the inflation premium and the maturity risk premium to find the nominal rates of return on a 1-year treasury bond, a 10-year treasury bond, and a 20-year treasury bond. And they're saying that assume that the risk-free rate, assume that the real risk-free rate is 3%. So we have R times R star, R equals the risk-free rate, the nominal risk-free rate equals the real risk-free rate. The nominal risk-free rate equals the real rate of return plus the inflation premium plus the maturity risk premium. So we just start, this is given, this R star, this was the inflation premium that we calculated for the 1-year bond. Maturity risk premium is 0. So the nominal return on a 1-year treasury security is 8. And then we just use those numbers that we just calculated to find the nominal return on a 10-year treasury is 11.4. On a 20-year, it's 12.65. Now, if these were corporate bonds, we would add the default risk premium, which is, there's nothing to calculate it. That's just given to you. And we would also add the liquidity premium. That's also given. There's nothing to calculate. This is just showing this hypothetical yield curve where you have your risk-free rate, you have your inflation premium, and then you have this maturity risk premium. Those all are added together. Okay, we can skip this. And this is just showing, as I was mentioning, this is a yield curve for a treasury bond. This is a yield curve for a AAA rated, a AA rated corporate bond and a BBB corporate bond. So the difference here from here to here is the liquidity premium plus the default risk premium. And then from, excuse me, and then from the AA to the BBB is simply the, you've got a higher default risk premium. Okay, so that we're skipping the rest of this. Pure expectations theory, we're skipping. Let me, that is not covered in this class. What they're doing, I'll just tell you what it is. It's what they're doing with pure expectations theory is they're trying to figure out what interest rate bonds will pay in the future. So like they'll say, okay, well, if we know what a 2-year bond pays, and if we know what a 5-year bond pays, then this is what there's supposed to be a 5 over here. If a 2-year bond is paying 6.2% and a 5-year bond is paying 6.5%, we can use those two numbers to figure out what a bond would pay from year 2 to year 5. That's what pure expectations theory is. All right, let me talk about this last slide here. So we talked about this formula that where we can calculate the nominal interest rate, the nominal rate of these bonds. And at the beginning of the slides, we talked about the factors, the determinants of interest rates. Well, there's some other factors that come into play that can influence interest rates, some macroeconomic factors. For example, the Federal Reserve policy, whether they're raising or lowering rates. And so, the Fed will come out when they want to stimulate the economy, they'll lower rates. When they want to tighten, if they're worried about inflation, that the economy is getting too superheated, and they want to try to have the economy, to slow the growth of the economy a little bit because they're worried about inflation, then they will raise interest rates. So the Federal Reserve policy influences interest rates, obviously. Whether the government has a deficit or a surplus, the government has had deficits for a long time. For the foreseeable future, we're going to have deficits. And so what happens with federal deficits is that they have what's called, what happens is you have what's called a crowding out effect, where you have this demand for money, demand for loans. You've got the supply and demand for money. Well, when the government runs a deficit and becomes a borrower, you have this crowding out effect where they're crowding out private investment. And so the bottom line there is that it pushes interest rates up higher. International factors, as far as international economies and international interest rates can affect our rates. And then the level of business activity. If we're in a recession, that kind of goes along with Federal Reserve policy. If there's not a lot of business activity, not a lot of demand for money, the interest rates will be pushed down. If there's a lot of business activity, demand for money is up, interest rates will be higher. Okay, so this is a pretty short chapter. The main takeaways, really the main takeaway from this chapter is you should know what a yield curve is, and know the determinants of interest rates, and know what those different factors are in that formula that make up the nominal rate. Okay, until next time, goodbye.